Let me tell you something uncomfortable. The stock market does not care if you're smart. It does not care if you're right. And it definitely does not care if something doesn't make sense. Because the market has a long history of doing things that are completely irrational for much longer than any human being can emotionally survive. Today, I'm going to tell you 10 true stories from stock market history that prove one simple idea. The market can stay irrational longer than you can stay sane. And once you hear these stories, you'll never look at investing the same way again. Story 1. Tulips that cost more than house. In the 1630s, in the Netherlands, people lost their minds over flowers. Not gold. Not land. Flowers. Tulip bulbs became speculative assets. Some single bulbs were traded for the price of large houses, luxury furniture, and years of wages. People didn't even want to grow the flowers. They just wanted to sell the bulbs to someone else for more money. And then one day, no one showed up to buy. Prices collapsed almost overnight. Fortunes disappeared. Lives were ruined. Nothing about tulips changed. Only belief did. That was the first lesson markets ever taught us. Price is not reality. It's a story people agree to believe. Story 2. The crash that fed itself 1929. In 1929, the U.S. stock market collapsed. But here's the strange part. Many companies were still profitable. Factories were still running. People were still working. Stocks fell because people thought they would fall. Investors sold because others were selling. Fear fed fear. Panic created more panic. The crash didn't begin with bad fundamentals. It began with a loss of confidence. The market didn't break because the economy failed. The economy failed because the market broke. That feedback loop destroyed an entire decade. Story 3. Japan's market never came back. In 1989, Japan was unstoppable. Stocks soared. Real estate exploded in value. At the peak, the land beneath Tokyo was said to be worth more than all the land in the United States combined. Japanese stocks were trading at valuations that assumed infinite growth. Then the bubble burst. Here's the part that still doesn't make sense. The Japanese stock market never truly recovered. More than 3 decades later, many investors are still underwater. Imagine being right about the long-term future of a country and still losing money for 30 years. Time does not heal all market wounds. Story 4. A grocery store that fought Wall Street. In 1923, the founder of a grocery chain tried something bold. He tried to corner his own stock. He bought shares aggressively, betting that Wall Street would be forced to buy from him at higher prices. Wall Street responded by doing the opposite. They shorted the stock relentlessly. The price collapsed. The company nearly failed. A supermarket, selling basic food, almost triggered a financial disaster. The lesson? Even when you think you control the rules, the market can still decide to crush you. Story 5. Florida sold land that did and kissed. In the 1920s, Florida became the hottest investment destination on earth. People bought swampland, underwater plots, land infested with mosquitoes. Some properties were sold multiple times before anyone even visited them. Buyers assumed prices would keep rising forever. Then hurricanes hit, financing dried up, the bubble popped. Many investors never even saw the land they lost money on. Speculation doesn't need reality. It only needs momentum. Story 6. A company with no business model. In 1720, investors poured money into a company promising riches from South America. What did the company actually do? No one really knew. The plans were vague. The profits were imaginary. The hype was real. Money rushed in anyway. The bubble burst violently. Trust in markets collapsed across Europe. This happened 300 years ago. And yet people still fall for the same pattern today. Story 7. The meme stock that broke hedge funds. In 2021, something unprecedented happened. A struggling retail stock became the center of an internet movement. People didn't buy because of earnings. They didn't buy because of fundamentals. They bought because it was funny. Because it felt rebellious. Because it felt like a game. Billion-dollar hedge funds lost billions. The price moved not on spreadsheets, but on memes and emotion. It proved something terrifying. Markets don't need logic to move. They just need people. Story 8. Companies cheaper than cash. During major crashes, some companies traded for less than the cash sitting in their bank accounts. Think about that. You could buy the entire business, take the cash, and still have factories and employees left over. For free. Yet investors refused. Fear made people believe even cash would somehow disappear. When panic takes over, logic doesn't stand a chance. Story 9. Stocks that rose BQs, nothing changed. Sometimes companies announce a stock split. Nothing about the business improves. Earnings don't increase. Cash flows stay the same, yet prices often jump. Why? Because humans like smaller numbers. Because it feels cheaper. The market rewards perception, not math. Story 10. Negative VL abuse and cess. In one famous case, a company spun off a small subsidiary. Investors went crazy for the spinoff. They valued it higher than the entire parent company, which meant mathematically the rest of the businesses were priced at negative value. Factories, brands, employees, all supposedly worth less than zero. The market didn't care. It never does. Final takeaway. The real danger. So what's the lesson in all this? The stock market is not a machine. It's not rational. It's not fair. It's a crowd of humans reacting to fear, greed, stories, and hope. And that's why this quote exists. The market can stay irrational longer than you can stay sane. You can be right and still lose. You can be early and still go broke. You can understand everything and still suffer. The danger isn't ignorance. The danger is believing the market owes you logic. It doesn't. If these stories surprise you, remember, they all actually happened. And they'll happen again, just with different names and different charts. If you enjoyed this video, consider subscribing for more calm, honest stories about markets, money, and human behavior. Because in investing, understanding people often matters more than understanding numbers. Thanks for watching.